The dollar is breaking. The lifeboats are already being built. China pulled the trigger right as America crossed a $1 trillion interest bill. If you earn in dollars, spend in dollars, trade in dollars, you're in the path of this. You'll see three hard signals that turn headlines into hits on your life. You'll see the short window before rates jump. When those signals line up, the quiet risk stops being quiet. Miss these tells and the bill lands on you before the news admits a problem. Start with the part most people miss. This isn't a normal debt cycle. It's a stress loop. The United States owes more than $37 trillion. Each new dollar of debt adds a bigger interest bill. That bill is now above $1 trillion per year. It grows even if nothing else changes. It grows because the rate on new borrowing keeps grinding higher. Auctions never stop. And the world has started saying no. The old story says a dollar is the anchor. The new story is that big players are already building lifeboats. BRICS rails are alive. Gold pilots are alive. New digital rails move value outside the old pipes. These exist because trust in the anchor is slipping. That's why timing matters. You wouldn't pull support from a rival when they're strong. You would pull it when their interest bill explodes. You would pull it when refinancing risk peaks. You would pull it when one more shove can move the whole table. The surface still looks calm in places. Charts can show the dollar holding against weaker currencies. That doesn't mean the base is stable. It means demand for dollars is tight at the edge while trust weakens at the core. China holds hundreds of billions of U.S. debt. They trimmed for years. Now the pace is faster. They're unloading into heavy issuance. They're unloading into sticky inflation and a central bank that can't cut fast. That isn't routine. That's pressure applied at the worst possible moment for the United States. You need three tells. They show up in the same order when stress builds. If you watch them, you'll not need a pundit to explain what already happened. You'll have seen it coming. Signal 1 is the foreign holding slope. Watch the line, not the giant total. If it flattens for months while Treasury supply keeps rising, that's the first alarm. If it bends lower and stays lower, that's a withdrawal signal. Each dip forces higher yields. Those yields bleed into mortgages, into car loans, into credit cards. What looks like an overseas move becomes a domestic tax. It's a bill on people who never touched a bond. It's a pay cut that doesn't show up on a paycheck. Signal 2 is the cost of protection. This is the price to insure against a United States payment scare. You don't need the contract name. You need the direction in the stick. If the price drifts up for days and won't fall, worry is spreading under the surface. Think of it like fire cover on the biggest building in the city. If the premium jumps and stays high, no one shrugs. People check exits. They move cash. The smoke starts at the core, then reaches the street. Signal 3 is auction strength. Each sale has a turnout score. Strong auctions clear with depth and steady price. Soft auctions clear with thin demand and higher yields. One soft sale can be noise. 2 or 3 close together is doubt. Doubt at the heart of the system doesn't sit still. It hits mortgage quotes within days. It hits credit lines. It hits currencies as money looks for a quieter rail. Here is where this flips from odd to dangerous. The signals don't need to flash red all at once. The first turn opens a window. If the second confirms and holds for a week or two, the odds of auction wobble rise fast. When auctions wobble, the loop speeds up. Yields rise. The interest bill grows. The next sale demands sweeter terms. Old debt rolls dearer. New deficits need fresh cash dearer. Confidence erodes slow then fast. By the time the headline says crisis, the price is already on your bills. You might ask if domestic buyers can plug the hole. The central bank can buy. Banks can buy. Pensions can buy. That can make the surface look calm. But the cost moves somewhere else. If the central bank absorbs too much, the dollar can soften and import prices creep. If banks absorb too much, they ration credit to households and small firms. If pensions absorb too much, they reach for yield and take risks they shouldn't. The roof looks steady. The beams crack. Most people think the main risk is inflation or recession. The deeper risk is losing the buyer of last resort. If the world decides the United States must always pay up to borrow, then every price in your life resets higher. Rent lags, then jumps. Food lags and jumps. Insurance lags and jumps. Wages stalls, credit tightens. This is how a quiet portfolio move in Beijing becomes a loud pay cut in Boston and Phoenix and everywhere in between. Add the part that rarely makes the page. The loans that hold the world together are priced off treasuries. When that base wobbles, the plumbing everywhere shudders. Swap line strain, repo pipe strain. Dealers widen spreads to shield themselves. That's when strong markets feel weak and weak markets break. That's when people say no one saw it coming. The truth is the tells were on the board the whole time. History doesn't repeat cleanly. It still rhymes. Reserves that looked eternal cracked the same way. First, a slow drift by key holders, then a surge in funding costs, then a rush into alternates that once looked fringe. The pound lived this. Other old anchors lived this. The names change. The math doesn't. The system needs trust and cheap rolling credit. Remove either and the rest buckles. So what should you do with this? Use if-then rules. If the foreign holding slope bends lower for 3 months while issuing stays heavy, then assume borrowing costs want to rise into your life. If the cost of protection climbs and won't ease, then plan for choppy markets and anything tied to the dollar. If two soft auctions land close together, then stress is already inside your mortgage rate and inside your card APR. You don't need to call the week. You need to read the sequence and move before it hits you. Make it real. Lock fixed rates at the signals flash. Don't take teaser rates at face value when protection costs rise. Don't stretch for risk if short bills pay to wait. Keep cash flow clean. Cut floating debt where you can. Build buffer. Add exposure to assets that don't break when money tightens. Trim trades that only work when money is cheap. If the signals ease, stand down. If they stay loud, act. Pull the camera wide and see the board. The dollar is breaking because the cost to fund it's breaking higher. The world is building lifeboats because the anchor is slipping. China timed its retreat to the one moment America could least afford it. The mechanism is the loop of bigger issuance and bigger interest. The tells are the slope of foreign holdings, the cost of protection, the strength of auctions. Once to align, the window is short. The logic is simple. If the tells are live, protect cash flow. If they're calm, wait. Never ignore them. If you want these signals decoded before they hit headlines, subscribe now so you don't miss the next move.